30 minutes until the start of cash trading. We're looking at futures mildly down. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, markets on edge with tariff concerns eating into a banner month for stocks. The president accusing China of violating the country's trade agreement, and another batch of retailers sound the alarm on an unpredictable outlook. Katie, walk us through the pre-market reaction here.
I would be happy to. Let's take a look at Ulta shares surging after raising their profit forecast for the year. You can see up currently about 10% in the pre-market. A different story for Costco, navigating tariffs well by rerouting products and examining price changes. Shares down a little bit. And then a much different story for Gap over there, down about 15% right now, struggling with a combination of weaker demand, but also the trade war impact on the business. We'll discuss all of that and more with the CEO next hour, Matt.
All right, I want to also point out that Dell reported a profit outlook that beat estimates as AI demand remains strong. Shares right now off about 1.5% in tandem with the broader markets, but we're going to keep an eye on that story as well, Katie, as AI really has been obviously the driver for the gains we've seen this month.
Absolutely, but let's get back to trade now because markets continuing to digest that latest tariff development. President Trump posting on Truth Social, writing, China has totally violated its agreement with us, using all caps there. So much for being Mr. Nice Guy. We also heard from Treasury Secretary Scott Bessent saying that negotiations remain in limbo.
I would say that they are a bit stalled. I believe that we will be having more talks with them in the next few weeks, and I believe we may at some point have a call between the president and party chair Xi.
Let's get the latest now with Bloomberg senior editor Michael Shepard. He's in Washington, D.C. for us. So, Mike, what do we know about this? It looks like a breakdown in U.S.-China relations.
Well, we are definitely getting the feel-good vibe fading from the talks in Geneva. It's clear that there is a rupture in the conversation that had moved toward maybe easing some of the trade tensions between the world's two largest economies. Remember, during those talks in Geneva, they had agreed to lower the significantly higher tariff rates on each other's goods. The U.S. had put its rate as high as 145%. That was lowered to 30% pending further discussions, and China did the same. Now, as part of those discussions, the U.S. had been looking for China to also lower some non-tariff barriers, and that included controls on exports of things like rare earths and other critical minerals that are important to the technology supply chain here in the U.S. Now, while the president didn't spell out in his Truth Social post what set him off there, Jameson Greer, his top trade negotiator, indicated today that it may have something to do with China slow-walking the removal of some of those barriers on exports of critical minerals, Matt.
Well, we heard from the Treasury Secretary Scott Bessent last night saying that talks between the two countries have totally stalled. And his view was that maybe there needs to be a call between President Trump and between President Xi of China. We know the two haven't spoken since before the inauguration. We also know that the Trump administration has been angling for a conversation between the two. Are we any closer to that?
Well, Greer said this morning that they were still working to arrange this call, and a conversation between President Donald Trump and President Xi Jinping certainly could break the ice. And we did see that having some effect when Trump spoke with European leader Ursula von der Leyen after Donald Trump threatened a 50% tariff on imports from the EU. And that led the president to move back his deadline for imposing that much higher tariff rate to July 9th, pending further negotiations. So it could be a critical icebreaker, and yet China and the U.S. remain very far apart. The issue of export controls is a real one, not just for the U.S., but also for China, which has objected to limits on exports of semiconductors and other sophisticated machinery needed to advance their ambitions in areas of artificial intelligence and other sophisticated technologies.
All right, that is Bloomberg's Michael Shepard joining us from D.C. with the latest on the negotiations between the world's two largest economies. But let's talk a little bit more specifically about the U.S. economy and U.S. consumers hitting the brakes in April while inflation remained tame. We're going to break down this morning's data with Bloomberg's international economics and policy correspondent Michael McKee joining us from Dallas, which is fun. So let's talk about the PCE numbers that we got at 8:30 this morning, really coming in across the board, right on the screws. And then you take a look at personal spending, pretty much coming in line with expectations as well. I can't imagine this moves the needle too much for the Federal Reserve.
No, Katie, the Fed is not data dependent at the moment because it has to wait and see what the impact of whatever the policies turn out to be from the Trump administration, what he wants in tariffs or what the courts will allow him, et cetera, et cetera. But we did get to 2.1% on a year-over-year basis for the headline, and the headline is the Fed's 2% target. So they are within 1/10 of a percentage point of that target. They would have their soft landing if not for all this tariff talk. We also saw the core rate come down as well, a big drop in energy there. So we are starting to see some progress on inflation that would have probably led to more rate cuts if the Fed were able to figure out what was going on. The spending number is interesting because, of course, people front-loading what they wanted to buy in March, and then it falls off in April, although incomes are still relatively strong, so they can buy things in the future. But it is that pull forward that has been the news today. The advanced goods trade figures, just totally shocking, down 20% on imports, which is the most ever. Factory goods, industrial supplies fell by 31.1% in terms of imports, and auto imports fell by 19%. So wow. Not only were consumers front-loading, but businesses were front-loading as well.
All right, Mike, thanks very much for that wrap. We're looking forward to University of Michigan data at 10 o'clock as well. Bloomberg's Michael McKee there, a policy and economics correspondent. On the earnings front, a mixed outlook for retailers from Gap to Costco to Ulta and Dell. Tariffs maybe impacting the supply chain, changing the way businesses think about that, and consumer sentiment weighing on demand, as well as discussed with Columbia Threadneedle Investments senior equity analyst Mari Shor, who joins us from Boston. Mari, first of all, what do you make of the Gap issues? Because they said tariffs could take a $300 million bite out of their bottom line, and the shares have lost about 1/5 of their value in the pre-market.
Yes. Thanks for having me. Gap is trading down in the pre-market, as you said, I think for two reasons. The first is that the expectations had risen significantly into the print. So even though the Gap and Old Navy brands are taking share, the sales results were not as strong as some had hoped. And then the second point is on the tariffs, as you said, management did not include the tariff impact in their guidance, but it will be a significant impact, about 10% to full year operating profit. And so that is now something that investors are also having to bake into their numbers.
Yeah, it's interesting to dig into the details of their portfolio. Like you said, of course, the namesake Gap brand and Old Navy doing well. Athleta, Banana Republic, a bit of a disappointment, even though I love both of those lines, but clearly that didn't help in these earnings. Talk to us a little bit more about that tariff impact, because they said that they anticipate as much as $300 million worth of impact here. They're going to take some mitigation efforts. Does that number seem large to you? Seems large to you? Because you take a look at some of the sell side reaction, and a lot of folks were surprised, to your point.
The number does not seem large to me. After the Liberation Day announcement in early April, I immediately began doing analysis and running numbers for all of these companies, and Gap actually screened as one of the companies that was most exposed here. Some of that is given the nature of their sourcing, but also the fact that they sell most of their product domestically, whereas other global brands are selling a lot of their product in international markets as well. So as you said, they talked about a $300 million gross impact. but net it will be about half of that, which is about 10% to full year operating profit. So that number does not surprise me. I think overall Gap is one of the companies more impacted, but there have been others like Target, for instance, where I also thought we could see a greater impact, and management talked about being able to fully offset the tariff impact there. So I think overall, stepping back as we went through retail earnings, the tariff impact was actually a lot less than investors had expected. But in some cases, like you mentioned, Gap, investors had not been forecasting or assuming any impact in their numbers. And so now we are having to bake that in.
I was surprised by the strength of Costco's, not only their growth, both in store and online. I think online was 16%, but also the fact that they only get 8% of their goods from China. Less than 30% of their goods come from overseas. And I would have thought a big box store like that would rely a lot more on Asian manufacturing. What do you think about Costco?
Well, remember, about 70% of their total business is food and consumables. So most of that product is sourced domestically. And then, as you said, in terms of the product they're sourcing directly from overseas, it is a much smaller percentage of the overall mix. I think Costco has been one of the most consistent models for many years, if not decades, in all of retail. And we see that momentum really accelerating in the current environment. I think any company that is offering that mix of value, convenience, and a broad assortment like Costco, Walmart, Amazon, those are the models that we see taking share across channel and across category in the current environment.
All right, Mari, great to get some time with you on this Friday. Have a great weekend when you get there. That is Mari Shor. She is Columbia Threadneedle Investments Senior Equity Analyst. And next hour, we'll be speaking with Gap CEO Richard Dickson. Going to get into some of these issues around tariffs and the impacts to Gap's business. But let's take a quick check on futures. We're less than 20 minutes until the opening bell. You can see we're taking a little bit of a downdraft right now, but it has been a banner month for the S&P 500, up 6.2%. So some of that superlative probably is going to stick, even if we slip a fourth or 0.4%. Much more market action coming up next. This is Open Interest.
Let's get to high interest now. Look what's making headlines around the world. Israel has accepted a U.S. ceasefire proposal for Gaza that would involve a 60-day pause in the fighting and restore United Nations-led aid distribution to the Palestinian territory. The proposal includes Hamas releasing 10 live hostages, as well as negotiations for a permanent end to the fighting. Hamas has criticized the proposal as one-sided and has not officially responded. A colorectal cancer drug from Pfizer doubled survival time for patients with a specific genetic mutation, according to a new trial. The drug Braftovi cut deaths by 51% and slashed the risk that the cancer would progress by 47%. The results are a boon to Pfizer as it bets on cancer medicines to counteract weakening demand for its COVID products. And watch enthusiasts are snapping up used Rolex and Patek Philippe watches before possible tariffs from President Trump. The watch dealer Subdial saw a 160% higher than normal trading spike in April after people received their paychecks, with strong growth in the U.S. and the U.K. The phenomenon echoes another trend in Switzerland, where watch exports jumped by nearly a fifth last month. Katie?
All right, let's get back to these markets. And earnings season, it never truly ends, but at least for right now, it's winding down. And for investors, one thing is certain, and that's uncertainty. Bloomberg senior editor Eric Weiner joins us now to discuss. And you take a look at earnings calls transcript from this recent reporting season. Across industries, every CEO was dropping the word uncertainty.
Yeah, it was it's an uncertain time.
Yes.
But there's a lot of it. And when you're dealing with projections on earnings, it's much more difficult to game out if you just know what your customers are going to do. it's one thing, and that's difficult to game out. But when you have tariffs, when you have trade fighting, when you have geopolitical tensions, there's just a lot that you don't know. And this is a way for CEOs to sort of confirm to investors that they're not exactly sure where things are going to be heading in the next half.
I don't know who originally came up with it, but Howard Marks always says it's difficult to make predictions, especially about the future, right? There's always uncertainty.
Yes.
That's how it is. How much are CEOs and C-suites using this kind of excuse in earnings reports to buy time?
Oh, it is. It's all about buying time. The reality, though, so to Howard Marks's point, which is a great line, to his point, there is an added level of uncertainty now in that you don't know what's going to be coming in terms of levies on the products that you either need to build what you're building or that you sell. There's just a lot of price instability that's going on, and that makes it's always difficult to predict where your earnings are going to go.
Is there any way to quantify how much more uncertain it is now than, say, it was last quarter?
Well, it is more uncertain now because, I mean, just based on the numbers that we're seeing, the way that it's being played up is at historic levels. What's interesting to me is that it's higher than what we were hearing in 2020 when COVID broke, and it's higher than what we were hearing in 2008 during the global financial crisis. Those were deeply uncertain times. I mean, there is no game plan for COVID. So what do you do? And yet there's more of it now. And I think it's because of the rat-a-tat-tat everyday tweeting that the president does and the constant talking that just sort of flips things all of a sudden.
Yeah, it's interesting. I mean, you take a look at that great chart in this article. Uncertainty, uncertain, and uncertainties had been mentioned on earnings calls 3,100 times this past earnings season. You compare that to the second quarter of 2020, and it was greater than even then, to your point. Just quickly wrap this into the broader market because, yes, okay, we have CEOs coming out on their earnings calls talking about how unsure they are, but yet the S&P 500 jumping by 6% in May.
Yes. Well, this is also part. So if you're an investor, you're uncertain too, because it's not just that what the CEOs are saying, it's that the stock market's a forward-looking mechanism, right? You know, you're betting on where things are going to go. And if you're at this very high level, is this the time to enter? Is this a time to retrench? How much of this is real? How much of this is, to Matt's point, is just pushing things down the road? And so the uncertainty filters into the market, and that's why, although we're coming off a banner month, things have kind of flattened out a little bit, and that's sort of the recent. The tariff up and downs, and yet yesterday the court threw a monkey wrench into everything. So you just don't know. And as an investor, you really don't know where the S&P is going to head. And we're close to highs. I think we're about 4% from a all-time high on the S&P. So what do you do? When do you enter? And that's a tough call.
All right, Eric, great having you on the program. Thank you so much for joining us.
Thanks.
Eric Weiner there from Bloomberg News. Coming up, we discuss the tariff back and forth with Morgan Stanley's Mike Wilson, who says they think the bottom is in. So the second half is likely to be better than the first. This is Open Interest.
The markets haven't really had to come to grips with the idea that the economy might be slowing. We haven't really had that one piece of very, bad hard data where it's like, oh, aha, like sort of, recession risks are higher than we thought.
And that was Neil Dutta of Renaissance Macro on Bloomberg Television earlier today, speaking about the fragility of markets these days. Let's discuss now with Morgan Stanley Chief U.S. Equity Strategist and CIO Mike Wilson. And Mike, it didn't feel like things were that fragile in May. A gain of 6.2% on the S&P 500, despite what we were just talking about in the last block. All this uncertainty that's out there, all this caution from corporate America. What do you make of where we stand right now?
Well, I would say the fragility got priced. You know, we had a big sell-off, 20% sell-off plus 30, 35% in most stocks. And I think that the fragility now has moved to the bond market. You know, that's where the main concern is now, whether it's the global bond market with JGBs, you know, kind of getting out of bounds, and of course now with, you know, term premium in the U.S. Treasury market. I think that's where the risk is the greatest. The growth fears have subsided because, look, we did take the off-ramp on the tariff concerns. And from my perspective, I mean, like we were probably weeks away from having a recession. If those 140% plus tariffs had stayed on, I don't think there's any, you know, it's very little doubt that corporates would have had to take action with the labor cycle. But now that it's backed off and the stock market's up, you know who watches stocks more than me and us? CEOs.
Yeah.
Okay. So stock market recovers, loosens financial conditions. They say, you know what, hold off on the layoffs because things may be turning around. And I think we bought ourselves quite a bit of time, and that's why the market's responded to that. I don't think it's unusual.
You know, CEOs rarely admit that to us.
That's
on
why
air.
I was laughing.
Yeah,
They
exactly.
always say, I don't watch the stock on the day-to-day basis, but of course they do.
Yeah.
Mike, you think that the bottom is in and that the second half is going to be better, or at least you started the year saying the second half is going to be better than the first half. Do you still think that? I mean, obviously we came down a lot, but we came back a lot, and now we're, you know, flirting with 6,000 again.
That's right. Markets and economies are reflexive. Okay, we know that. And, you know, I think we had a unique view coming into this year. Our view is that things were already slowing dramatically, and particularly on earnings. Earnings revision breadth was rolling over. The AI story was losing steam. Okay, but all of those things now have bottomed from a rate of change standpoint. And that's what stocks care about. That was the focus of our mid-year outlook, was that the rate of change is now bottomed. It bottomed in economic terms,
right.
in you know, fiscal, monetary policy, I think is bottomed in terms of the most hawkish we're going to see. And that is all going to now lead to a better rate of change in the second half, which the stock market is already discounted.
All right, Mike, we are just getting started. You are sticking with us through the opening bell. That is Mike Wilson of Morgan Stanley. Much more coming up at the open next. This is Bloomberg.
We are moments away from the start of trading on this Friday, last day of the week, last day of the month. It looks like we're going to have a down day, but it's been the best month of May since 1990, since before Nirvana came out with Smells Like Teen Spirit. So S&P futures down 0.2%. Before Pearl Jam, before Nine Inch Nails. The NASDAQ futures are down 0.1% as well. 1990 was a long time ago.
Yeah.
It wasn't so long ago that Darden Restaurants didn't own the Olive Garden, which is lovely. They're ringing the opening bell today. The stock has tripled in the past 5 years. It's up 50% in the past 2 years. They're doing pretty well. First Interstate Bank System, ringing the bell down at the NASDAQ marketplace. Very interesting company there as well. But I'm going to hand it over to you, Katie, because there's a lot going on the last day of earnings season.
Absolutely. The last gasp of earnings season, really delivering in a big way, and in many cases to the downside, which we'll get to. But let's start with an up arrow, and that is Ulta surging after raising its profit forecast for the year. A hard thing to do, but shares up 13% in response. Costco really sort of wiggling between gains and losses in the pre-market. It's navigating the tariffs relatively well. It's rerouting its products and examining price changes. Traders still deciding what to do with that. But the big story for me today is what's going on with Gap. Shares down 18% at the open. This company really struggling with the combo. You have weaker demand, but you also have the trade war impact on the business, coming out with some of the impact up to $300 million, really shocking consumers. And it's going to be fascinating. We have a conversation with the CEO coming up next hour, Matt.
Yeah, I'm very much looking forward to that. Speaking of the 1990s, I don't feel like the Gap or Banana Republic has really changed much since then. So we'll ask him about his vision for the stores. Dell reported a profit outlook that beat estimates as AI demand helped them out. Shares right now rising after they were lower in the pre-market. So maybe a little bit of a sentiment shift here. Dell is just one of really a handful of companies that came out overnight and beat expectations. Bank of America says the latest turn by the Trump administration to favor tax cuts and lower tariffs could spell trouble for markets. The flip in U.S. economic strategy could incentivize traders to ditch bonds and pile back into AI and crypto trades, which would risk inflating a market bubble, according to the team led by Michael Hartnett. Are we already back to a bubble? We're here with Morgan Stanley's Mike Wilson. That seems... Wow, that's an interesting call. That's a way to get noticed on a Friday.
I mean, bubbles are, apparently every year now in certain things. I mean, I do agree with Michael in the premise. Okay, we've been in an environment for, I would say, post-GFC, where policy has sort of elicited, mini bubbles in certain assets. The money moves to the hot kind of toy, whatever it might be. But it's nothing like the late 1990s. Like, I don't think what we're seeing in AI, anything like the late 1990s, is just not as broad. I mean, there are 4 large companies spending all the money. There are maybe 8 to 10 big beneficiaries of that spending. That was like a mini bubble. We talked about that at the end of last year. One of the reasons we were a little bit more negative on some of those stocks coming into the year was because there was a deceleration in growth. But it's not like in the 1990s when you had every enterprise overspending on equipment. You had this huge IT spending bubble. So I don't agree that we're in a bubble, but I do think the policy we've chosen, okay, which is to kind of at every sign of trouble come in and stop it. It does elicit that type of behavior where that's why you get this chasing going on because buy the dip is a function of that policy that we've been doing for 15 years.
Yeah, and I mean, largely, if you take a look over the grand scope of time, buy the dip has worked because stocks go up in the long run. But I take your point. It kind of feels like bubbles in the eye of the beholder here. But I am curious where you think we go from here, especially when it comes to the AI trade. That narrative had been out there that, it was getting kind of tired. There was a lot of existential worries over DeepSeek and cheaper models coming through.
Canceling leases.
Exactly. But it feels like, especially with these NVIDIA results that were this week somehow, it feels like a long time ago, we're still putting our foot on the gas here.
Well, what I would say is that the AI is transitioning from the infrastructure plays, okay, so the investment cycle, to the adopter phase. And that's what we've been talking about for the last 6 months. Is now we have the compute power. It's built. There's going to be more to be built, but that initial surge is kind of done, and now it's going to continue, but at a slower pace. And now the fun part starts, right? Let's build the application layer. Let's build the killer applications that then can make, we can diffuse the technology into the economy. The price is coming down. That's when technology takes off. That is the essence of Moore's Law and tech diffusion. That's when you can actually get the productivity benefits. And so we've always had the view that 25 was going to be in terms of the productivity, but 26 and 27 is when we think that productivity benefit can start to come through.
Is that what drives us to 6,500? I mean, that combined with the fact that tariffs turn out to be not so bad, at least at these levels, and no one cares if we blow out the deficit another couple $1 trillion.
Well, it's another part of our rate of change argument, right? So that AI now is moving to
focus on the rate of change. That was the title of your note.
Exactly. And so like AI was a negative in terms of ROE and return on invested capital. It was a cost. And now the rate of change on AI from a broader market perspective is turning into a tailwind for margins and productivity. And that's what the market is. That's another factor in our more positive view over the next 12 months.
Well, I actually want to go back to the bond market. Speaking of the deficit, you mentioned before the break that things are actually looking a little bit fragile, not so much in the equity market, but perhaps the bond market. And I'm curious, in your role as chief U.S. equity strategist, how much time are you spending looking at the 10-year yield?
Well, I spend a lot of time looking at the 10-year in any environment because it is the pricing mechanism for all assets. As we've said for years now, 450 is kind of that crossover point, and it still continues to be a crossover point. When you get north of 450 on a 10-year, you start to see negative correlation to equity multiples. Okay, so we're right around that level. And by the way, I'm pretty sure the authorities know that as well. So they try to defend those levels. I don't think we're going to see a real defense.
Authorities meaning the Fed.
All of Fed, Treasury,
but not Congress. You're not.
Well, Congress is a different animal. I mean, and I've made this statement before. It's maybe controversial. I believe Treasury is somewhat captured by Congress, right? They got to fund it, and the Fed is somewhat captured by Treasury. They got to help out. So they work. It starts with the spending. and then it trickles down. And so, I don't think we're going to see an aggressive action until we get to 5. If we get to 5%, we said this last time, going to 5% is going to be bad for stocks in the short term.
Right.
However, if we get to 5%, I'm pretty confident they're going to intervene.
Well,
and that will be positive.
For better or worse, it feels like we are just glued to 4.5%. We just toggle around in a range around
until
that
we get
number.
over it.
Until we get over it.
And then we watch for 5.
But then we go back down, and we're back at 4.5%. At least that's been the story of the past couple months. So, Mike, what do you make of that?
Well, I would say the other side of that too is let's not ignore what's going on in Japan. Okay, so they're way ahead of us in terms of using the money printer to kind of backstop bond market. They've been doing it for 30 years, right? And QE, they were the originators of that, and we followed suit. And so now the question is, okay, now they have inflation. Okay, and the yen, by the way, is a big part of that. So the question is, can they control the yen's movement? I don't know if they're more focused on the yen going south of 140, okay, or they're more focused on keeping JGBs from blowing out to higher levels. But it appears to me, as an observer of markets, that when the 10-year yield or 30-year yield gets to a certain level in Japan, or the yen gets closer to 140 against the dollar, we also see intervention. So these are all related. These are all related. But the fact that we're seeing these things get pinned around these key levels suggests to me that they're observing it, and they're gonna try to control that.
All right, keep an eye on Japan. We'll be doing that over the weekend. Hope you have fun too. That is Morgan Stanley's Mike Wilson. Great to speak with you. Let's take a closer look at this market right now. It is the end of the month, and things could get weird as we get closer to the close. But at least where we stand right now, we're looking at very slight losses. And you take a look at the breakdown of this market, there's more breadth to the downside. You can see that only 139 names in the S&P 500 are higher right now, much more to the downside. You have one relatively big gainer today, and that is Costco. This is an earnings story, of course. We heard a little bit from the company about how they're navigating tariffs, and shareholders seem to like that news. You also have Netflix and Palantir moving higher. You take a look to the downside, though, and this is where things could get dicey, because your biggest loser on a points basis right now is Nvidia, chopping about 5 points off the index, down about 1.3%. Then you have Apple, Amazon, Tesla also trading to the downside as well. That could become a big weight as we get deeper into the trading day. But let's take a look at the sector level as well. It's broadly the same story, limited upside here. Consumer staples taking the lead right now. That, of course, comes down to Costco. You also have utilities in the green as well. A very defensive setup on the last trading day of the month. You go down the list right now, tech, healthcare, and energy in the red, Matt Miller.
Yeah, all red. We could turn around and see some gains at the end of the day, right? It's
could get weird.
The last day of the month. A lot of window dressing could be in store. Coming up, one more measure in President Trump's proposed tax bill is alarming Wall Street. A real concern, especially for foreigners or investors in foreigners. We'll tell you what it is next.
All right, it's time now for top calls. Some of the analyst action in focus this morning. And first up, Airbnb getting cut to a sell over at Truist thanks to soft summer leisure travel trends in both the U.S. and in Europe. Next up, we have Rockwell Automation getting raised to a buy over at Barclays. The firm cites an improving sales outlook for the manufacturer. And finally, I want to highlight the ag firm AGCO getting downgraded over at Citi. The firm says it sees less upside in shares, falling a 30% post-Liberation Day rally. Shares currently off by about 2%, Matt Miller.
All right. Thanks for highlighting AGCO. More now to on one of the most read stories on the terminal, and one that I have been obsessed by since I read it last night. It's so well written. I highly recommend you check out this story on an obscure tax item in one big, beautiful bill. Wall Street is growing wary of what is known as Section 899, or the Revenge Clause, Trump's tax treatment of what he's doing with tariffs. If signed into law, it could repel foreign investors even more. Deutsche Bank says the tax amounts to, quote, weaponization of U.S. capital markets into law that challenges the open nature of U.S. capital markets by explicitly using taxation on foreign holdings of U.S. assets as leverage to further U.S. economic goals. We're joined now by Bloomberg's managing editor for markets and editor on this story, David Papadopoulos. David, fantastic story. By Yishi and Liz
I like
McCormick.
The hype.
Yeah.
Well,
he doesn't say that to just everyone.
Look, so what really is in this legislation is that, you know, if another country is hitting us with taxes that we don't find fair, we're going to clobber them with taxes as well. But it seems to me like this is Trump's tax version of tariffs. Like he's just looking to take money from foreign players that want access to this market.
I think that's right. I think what it is of a piece with this administration and this president's view, Matt, that it's an incredible privilege for foreigners to have access to our markets, to have access to our treasury bonds, access to our Mag 7 stocks. And so, you know, if you want that access and you happen to be from a country that we deem is treating us unfairly from trade perspectives, pay an additional tax. If this bill approved by the House, goes through the Senate, is signed by the president, it would be on some investors an additional tax of as 5 percentage points, and it could go up from there.
So I want to talk about the scope here, because you mentioned Magnificent Seven stocks. We're talking about U.S. assets broadly here, right? Is there any one asset class that is particularly vulnerable?
So, Katie, I would say that for starters, some of the details are still a little fuzzy for us and for others, but our sense is that the thing that would be affected the most and hit the most is income that investors earn on treasury bonds. Of course, outstanding U.S. treasury bond debt, somewhere around $30 trillion. That throws off an enormous amount of income each year, a huge amount of that. Don't ask me for the exact percentages. I don't have them at hand.
Read the story.
Read the story. A huge percentage of that is in the hands of foreigners. And yes, if you are from, as of right now, from France, the UK, Canada, Australia, among other countries, you will now pay this additional tax if this bill goes through. Listen, it's a gambit that I suppose can work, and I can see what they're going for. But Matt, at a time when the whole American exceptionalism story is really in question, and investors are already kind of fleeing U.S. markets. U.S. markets are by far underperforming global markets. It's another thing that's sort of just like nudging investors to
leave. It's like asking investors to leave. Please take your business elsewhere, you know? Don't list your company here. Don't buy our treasuries. I mean,
it's just curious to me because typically at times like this, when a country is effectively dealing with a bit of a, trying to stem what is effectively capital flight, they usually say soothing things and they try to keep investors hanging around. May I offer you a drink? Sit down, hang out, hey, maybe a little bit higher interest rate. Here, you're right, to a certain extent, it's a little bit like, may I show you the exit door? Let me lead you there.
I mean, John Farrow always asks on surveillance if we can still expect foreigners to finance our purchases if we're not purchasing their goods, right? And this is, I think, along the same lines. Can they still be expected to finance everything we do if we're not letting them play here or profit off of our markets?
Well, there's no doubt that there's a real risk that, as amazing as the U.S. dollar is, as incredible a currency it's been as a storage of wealth and as a means of transaction, as incredible as U.S. markets are, the U.S. consumer market is, if you keep doing things that are potentially suddenly cutting them off from those markets, yes, you will discourage them to the point where they'll say, heck, I'll just simply go somewhere else.
So where does this go? Because you take a look at the market reaction to this, there hasn't really been much to speak of. Reading this article, this is the most detailed account I've read about this proposal, and I'll stress that it's a proposal. What is the
but it's a proposal, to be clear, but that has been approved by the House. So yes, the Senate could tear it up. It's possible, but it is we don't frankly exactly know what's going to become of it in the Senate. There's speculation that it will indeed get thrown out. There are also some who believe that there is going to be Republican support for it in the Senate. We'll find out. We don't. exactly have that answer right now. What I can tell you is this. Tax lawyers, going back 2 months ago, were initially onto this. While the rest of us were sleeping on it and Wall Street was sleeping on it, they were starting to spread the word. It only really jumped up onto the radar of Wall Street a day after the big, beautiful bill was passed last week. There was small rumblings Friday, slightly louder rumblings early this week, and then in the last couple of days, it's gotten really cacophonous out there. And
I hadn't heard anything about this. I hadn't
You missed
read
it all.
I hadn't read a less detailed. I hadn't read a broader brush strokes account of this to the point where I was actually surprised that Yi and Liz got so much commentary from the pros. I mean, everybody's been sidetracked by the taco trade.
Yeah, that's true.
And now we're reading about Section 899.
We should have all been listening to those tax lawyers.
Yes.
Luckily,
Matt, listen to your tax lawyer.
there you go. Luckily, of course, David Papadopoulos and the markets team had it covered. Really appreciate the time and reporting. Encourage everyone to go on Bloomberg.com and read that story. But coming up on this program, the S&P, it had a stellar month, but cracks are emerging as we roll into June. We'll tell you why next. This is Open Interest.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on stocks, and I feel less confident about my prediction that we could turn around today. We're not down by too much. S&P 500 off 0.6%. And Katie, as you've been saying, we're up 6% for the month. So it's the best month of May since 1990. NASDAQ off a little more, 0.75%. But with these big behemoths down so much, when Nvidia's off 2%, it's tough to get a gain. Apple is down 1%, Google off 1%, Tesla down a little bit less. The Gap has lost fully a fifth of its value today. Only Costco, at least on this board of chiclets, only Costco is gaining here.
There you go. Well, we'll be speaking about Gap in detail with the CEO next hour. But let's talk a little bit more about the month in markets. The S&P 500 now up by only 5.5% in May. That is still its biggest May gain since 1990. By far the best month of 2025. Let's discuss with Bloomberg Markets reporter Michael Ball. And I just keep coming back to the point that sell in May, especially this year, would have been terrible advice. You should not have sold stocks heading into May.
Yeah, this year was different because of what happened in April. The rebound in May made sense from a lot of perspectives with the step down in max protectionism and tariff war. But overall, now we're going into a much more questionable period for the rest of the summer.
The best May since 1990 seems like a lot. I mean, that's 25 years ago. You were born
That's
already.
more than 25 years ago.
Oh, right, 35 years ago. No, Katie wasn't even with us.
I didn't exist.
Michael may not have existed. Is this all about the turnaround? I mean, did we just plummet so far in the month previous that this is about catch up?
Yeah, I think so. I think a lot of people just sort of went full out of the market based on the Liberation Day announcements. And then as we saw the slow pivot back into a less of a kind of confrontational approach to this from the Trump administration, everyone found themselves actually net short and started to build positions again. And, that was exacerbated by other more mechanical flows. But overall now we find ourselves with people much more balanced and probably better positioned moving forward.
Right.
Not so long, not so short, but, more cautious, but still in the market.
So maybe back to a more neutral stance. We have 30 seconds left with you. Give us the bearish take. What are all the things that could go wrong over the next half of the year?
Yeah, I think some of your other guests touched upon it. There is more uncertainty now. We're back to this. What will Trump do next? He seems to be on the ropes again. He's lost some credibility. He's obviously being insulted by this sort of taco trade concept. And on top of that, we haven't really got anywhere with the budget bill. Now we have lost the tariff revenue for that bill, and that was actually a tailwind for stocks because it would be more stimulative than thought. Now that may not be the case. Obviously, there's still several more weeks till we get more of a final version from the Senate. All this just creates greater uncertainty. No one wants to step in front of that. And then we're all still sitting here waiting for the hard and soft data to tell us really what the real story is. Are we going to go down to the soft data, which has been weaker, or are we going to come up to the hard data, which is still hanging in a little bit but cooling?
All right, Michael, great to have you on the program. Bloomberg Markets reporter Michael Ball. You can read his work on the terminal by typing MLIV Go. Coming up in the next hour, JPMorgan's Meera Pandit on the muted reaction to the tariff court drama and some soft data at 10 o'clock. We are 30 minutes into the trading day, the last day of the week, the last day of the month, and the S&P 500 is down 0.5% as the gap loses 20% of its value. That's harsh, right?
That is harsh.
Katie Greifeld is here with me. I'm Matt Miller.
And I, as Matt said, am Katie Greifeld. We're
And I'm
looking
Matt Miller.
at a little bit of a downdraft on muted trading volume right now. This could spice things up. We do have University of Michigan data coming in, the final read for May. Sentiment improving a little bit, improving to 52.2 versus the prior read of 50.8. This is interesting. Take a look at inflation expectations. One-year inflation expectations actually dropping to 6.6%, which is pretty high, but relative to what the prior read was in the 7s, it's certainly a drop down. Then you take a look at the long-term measure there, 5 to 10-year inflation expectations also dropping to only 4.2%. That certainly looks better than the prior read of 4.6%. Let's get a little bit more detail now with Michael McKee. He is Bloomberg's international economics and policy correspondent. And this is soft data, of course, but it looks pretty good. Sentiment improving and inflation expectations coming down.
Well, it does follow the pattern that we saw with the conference board, although it is a little different, Katie, in that the big news in the conference board numbers was in the expectations index, which really jumped. We're not seeing a jump here, just a little bit of a rise, and it's still below 50. So people in the Michigan survey are not as optimistic going forward. The conference board's one-year ahead inflation number fell from 7 to 6.5%. So we're seeing about the same move here now. That may be because gasoline prices are coming down and food prices have come down a little bit. That may be the good news. What everybody always looks at with the Michigan numbers, of course, is what the political aspect of it is. And we're seeing that Democrats were more pessimistic this month, 33.9 from 34.4. And even Republican optimism was down. The number is 84.2 from 90.2. It's independents where we saw some increase in optimism, 48.2 from 46.2. So it does look like the middle of the country, which doesn't have as much of a dog in the fight politically, is feeling a little bit better about things. But again, 48.2 is still below the 50 break-even point.
Mike, I got to ask you about the importance of consumer sentiment data. You know, we got a blowout number a few days ago, I think, from the conference board, and Jay Hatfield was on and said, you know what, that just means that on that day there was good news or bad news. Like, it really has no effect on the hard data. What do you think about that? Because it seems to me, and painful to say as a Buckeyes fan, but Mich is very well respected.
Well, and so is the conference board. But the thing is we have learned over the years, and there have been a lot of studies on this, that what people tell the surveyors about how they're feeling about the economy doesn't always track with what they're doing about the economy. You look at both the numbers for the Michigan survey today and the conference board last week, and you see that they were up, but consumer spending fell off during the month. And that was likely because everybody spent so much earlier in March and February trying to pull ahead of the tariffs. So it doesn't really give us a hint as to where we're going from here, just that people feel a little bit better. And again, even the conference board expectations number that jumped was below the historical average of where it normally is. So it's not like people are feeling really happy right now. It's just a slight improvement over where they were.
All right, Mike, thanks very much. Michael McKee there, our international politics and economics, policy and economics correspondent out of, for some reason, Dallas. Who knows why he's in the Big D. We don't ask those questions all the time. We just let
him, roll.
He does what he does.
Yeah.
Joining us now is Meera Pandit, JPMorgan asset management global market strategist. Meera, how much attention do you pay to this soft data? As we've all been waiting for it to migrate to the hard, but we haven't really seen bad hard data.
We are in the continuing saga between soft data and hard data, this epic battle. And what we're seeing is that, look, the hard data is still looking pretty good. And now we can start to put a little bit more credence behind that because it is reflecting an economy that does acknowledge some degree of tariffs, but also tariff risks are not eliminated, but becoming more and more mitigated. So the hard data becomes a little bit more telling. The soft data is starting to contradict the hard data a little bit less as well. Consumer confidence expectations jumping. You're seeing in the regional Fed surveys some of those capex intentions starting to turn around. You're seeing from the standpoint of the Michigan sentiment, a little bit of turnaround there as well. Some of the measures of CEO confidence have started to turn around. In addition, so I do still think this mosaic of data is supporting the picture of an economy that's undoubtedly slowing, but not stalling out or headed for disaster.
Well, we have a great chart, and I hope we can pull it up, that if you take a look at how many times CEOs said some version of the word uncertain during this past earnings season, it was higher than even the second quarter of 2020. Over 3,100 times that word was mentioned. And it's really interesting to marry that with the actual facts on the ground, which is it feels like things didn't go as badly as expected. You had some companies pull their guidance, but not everyone en masse. And you take a look at the S&P 500, up more than 5% in May.
There's
alone.
the great chart.
There you go. You can see it. So, I mean, it sort of gets back to hard versus soft data. How do you marry together those feelings and those emotions and uncertainty with the fact that this market is ripping?
If you look at a long time series of hard data versus soft data, during the periods when they gap out the most, the hard data tends to be above the soft data. So sometimes people feel really crummy, but it doesn't necessarily impact how they're acting. Now, businesses maybe is a little bit different because CEOs tend to want to batten down the hatches a little bit, think about hiring, think about CapEx spending in short order. But on the consumer side, you often see that consumers are engaged in retail therapy. And so right now, it's not just around consumption, but it's actually around the stock market, where you're seeing a lot of retail investors buying the dip. So in the end, we could see that consumers not only support the economy and make it more resilient, but certainly they've been supporting the stock market as well.
Yeah, Matt, it's funny. We saw something similar during the pandemic where all the survey measures of sentiment were absolutely in the gutter, but consumers never stopped spending. And in the stock market, it doesn't look like they're stopping buying there either.
Will we avoid a recession, Meera? I mean, I guess we could have a technical recession because the pull forward of demand hit us so hard on GDP, technically, in the first quarter. We could have that again, right? Because we have this 90-day thing out until July.
What I'd say is, one, if we think about businesses pulling back, businesses are about 13% of the economy in terms of capital spending, while the consumer is 68%. So we want to overweight what the consumer is doing relative to businesses. What I'd also say is, yes, this pull forward in demand is significant on both the business and consumer side. But what it means is that businesses and consumers have the wherewithal to pull forward and build inventory and import more and buy more stuff. So even if we start to see a little bit of a drag, it still shows that underneath the surface, these two major actors of the economy are still reasonably intact. And so from our view, we do think we can avoid a recession this year, as some of these risks, again, have been mitigated but not eliminated. And we're somewhat back to December in terms of how we're thinking about our outlook. Undoubtedly, growth is probably going to slow, given the very high growth we've had over the last couple of years. And yet it doesn't necessarily look like we might be pushed all the way into recession because of some of this spending, because the unemployment rate still looks very low and is stably low.
Right.
Psychologically, that's good for consumers. Not a lot of cyclical excess, a lot of corporate debt termed out for a long period of time, a lot of consumers holding mortgages that have been initiated at very low interest rates or refinanced. So there's not a lot of boogeymen in the economy, so to speak.
I think it's interesting that the corporate only contributes 16%, did you say?
13 in terms of business.
13%.
In terms of business fixed investment.
Even with the capex, the massive capex we're expecting for AI, do you expect that to move the scale a little bit?
I think it can help. I mean, it depends if other companies pull back, but you have seen impressive results from the Mag 7 with them reaffirming some of that CapEx guidance, robust hiring with some of those companies. You're seeing evidence that AI usage and monetization is increasing. So it's going to be a different story across different areas of corporate America, certain sectors certainly pulling back. But it has been remarkable to see throughout earnings season, those Mag 7 earnings surprises really bottomed in 2Q 2024 and have been steadily rising since then. So it could be another year where Mag 7 is really holding up profit growth while some of the broader weakness weighs on other areas. You saw 2% upward revisions prior to NVIDIA to Mag 7 earnings for the year, relative to downward revisions to everything else. So some of these dynamics we certainly have to keep in mind when it comes to profits, the economy, capital spending. It all knits together.
All right, that's a good place to leave it. Meera, have a great weekend when you get there. That is Meera Pandit of JPMorgan Asset Management. Meanwhile, a quick check on these markets. We're about 40 minutes into this trading day, the last trading day of the month. Things could get weird around the close, but right now it looks pretty tame. You take a look at the S&P 500, down slightly, about 0.2%. The NASDAQ 100 not too much far behind, down about 0.3%. The bond market pretty well behaved. Volume is pretty low right now, trading volume relative to its 30-day average, but that could change, Matt.
Yeah, absolutely. I mean, you could see some window dressing into the close. It could be one of those witching days.
Yeah.
Who knows what that really means.
Multiple witches, perhaps?
Yeah, it could be. It could be, but that doesn't usually seem to really move the needle. Let's get a look at some of the single stocks moving at this hour. Dell is higher after it said it's seen significant increase in orders for servers to run AI networks. Remember, we're all moving on-prem and out of the cloud. Ulta results topping Wall Street estimates as shoppers continue to spend on beauty products, and shares of the Gap are absolutely plunging after the apparel company warned the impact from tariffs could reach $300 million.
And coming up in the next block, we'll be speaking to the CEO of Gap, Richard Dickson. You don't want to miss that conversation. This is Open Interest.
Let's get to high interest now. Look at what's making headlines around the world. President Trump is accusing China of violating an agreement with the U.S. to ease tariffs, escalating tensions further between the two countries. The president didn't specify how China had broken the agreement negotiated earlier this month in Switzerland, but he did say it in all caps. At that time, both countries said they would scale back tit-for-tat tariffs and continue trade talks. Good news for summer travelers. United Airlines sees ticket prices a little bit lower than expected for spring and summer, according to the company's chief commercial officer. He also forecast a very busy summer with Japan and Southern Europe as the most popular destinations for us in the U.S. And Costco is posting better than expected earnings in the third quarter. It's a sign that the nation's largest club chain is successfully navigating tariffs and economic turbulence, at least so far. Costco price increases are expected to hit later in the year as the company starts to sell new inventory. But Katie, they're going through these things on a product-by-product basis.
Right. Well, we're going to be talking about tariffs, of course, and inventory in a big way with the Gap CEO, Richard Dickson. Gap shares currently down about 20%. That is pretty bad, but somehow that's only the worst drop since April 3rd, of course, the day after Liberation Day. We'll talk through how the company is navigating and plans to mitigate up to $300 million in tariff impacts next. This is Open Interest. All right, it's time now for our Wall Street Week conversation. And for many years, the U.S. has led the world in innovation, driven in a large part by government funding for university research. But as Scarlet Fu reports, that could be about to change with deep cuts President Trump is making to institutions such as Harvard and Columbia.
Decades of government-funded research has attracted a pipeline of talent, homegrown and increasingly from outside the U.S. When you think of America's most cutting-edge companies, they often share some common traits: giant market caps, global reach, and oftentimes founders and/or CEOs born and raised abroad and educated in America.
I believe that it's nearly half of Fortune 500 CEOs that are either immigrants or children of immigrants.
Who's the next leader of a big multinational American company? There's a 1 in 5 chance that they were an international student.
The U.S. represents the premier destination for international students around the world.
What's become clear is as much as U.S. research universities depend on federal government money to operate and fund their research, they also depend on international students for the same, starting with paying tuition. That has come under direct threat when the Trump administration announced it would bar Harvard from enrolling international students, while the State Department halts interviews for student visas. A federal court has temporarily blocked the ban on Harvard.
Over 200,000 international students work in the U.S.
Miriam Feldblum is the president and CEO of the President's Alliance on Higher Education and Immigration.
Overall, the Department of Commerce has estimated that international students contributed $50 billion to the U.S. economy in 2023-24. That actually makes international education kind of the 10th largest export in the U.S. Even though the students are coming here, international students are only 6% of total student enrollment in higher education. So we're not talking about a large population, but the contributions that international students provide by their skills, their talents, what they buy, what they do, is far greater than what the 6% would indicate.
As the Trump administration cracks down on public funding to universities and visas for international students, other countries like Canada, Australia, and the UK are stepping up their recruitment efforts.
The administration's rhetoric would just discourage international students from choosing the U.S. as a destination, and they end up gravitating away from the country. Is that something you think about?
Every day. There's no doubt that if there's continued rhetoric, policy proposals, and actions that discourage international students from coming, that impact will be seen in decreased enrollments in the fall.
Does it lead to the closure of certain programs, certain innovative programs, or certain potential research breakthroughs?
We know, based on history, based on research, that our research productivity will diminish. Probably the number of patents being filed will decline based on past history. We don't know what will be lost. We know things will be lost. And this isn't about international students or international talent or domestic talent. The U.S. needs talent.
And Cornell Tech and Johns Hopkins University received donations from Michael R. Bloomberg, the founder and majority owner of Bloomberg LP. You can catch Wall Street Week every Friday at 6 p.m. New York time.
Meanwhile, more trade uncertainty as President Trump says China totally violated its trade agreement with the U.S. Bloomberg Balance of Power co-host Kayleigh Lyons has the latest. And Kayleigh, first of all, it's great to have you here in New York again today. President Trump tweeted this in all caps, but didn't give any details as to how China violated the agreement. Do we have any idea?
Well, we have an idea not from the president, but from others in his orbit, including the U.S. Trade Representative Jamieson Greer, who on another network said specifically that we aren't seeing the flows from China we were supposed to in terms of critical minerals, because in addition to this agreement taking the level of tariffs way down from the sky-high levels at which they were, it was also about making sure that some of the other non-tariff measures that China had taken in retaliation for the U.S. Slapping on these tariffs, like restricting the flows of critical minerals, were supposed to be eased as well. And Greer suggested that's not what we're seeing from China. This follows the Treasury Secretary Scott Bessent saying things that are really stalling out in trade negotiations between the U.S. and China, keeping in mind that the U.S. has, in just the last week or so, taken further action that could really be irritating China. The restriction of student visas or the revoking of them from Chinese students at American universities, also further restrictions around export controls, not just of semiconductor manufacturing equipment or chips themselves, but now software designs, semiconductor software designing thing as well. So they're seeing the tightening of export controls, other areas of tension in the relationship, and that may be making it more difficult for this to proceed in a positive direction.
Right, non-tariff barriers this time coming from the U.S. to China. But Kayleigh, I want to get your thoughts on some breaking news that we just got from the Supreme Court. Let me read the headlines now. That the Supreme Court, for now, is letting President Trump strip 500,000 migrants of legal status. In this case, siding with Trump for now in that immigration case. These headlines just dropping in the past couple minutes. What do we know so far?
Yeah, so this was a lower court order that said the administration had to, or the legal temporary status for these individuals from 4 countries, Cuba, Haiti, Nicaragua, and Venezuela, did have to stand for now while this process plays out in court. The administration President Trump had asked the Supreme Court to essentially allow him to revoke that legal status for now, and the court has done so. The operative words, though, are "for now." This once again is an instance of the court agreeing with the administration, at least in the interim, that they can do as they want. We've seen this with hundreds of thousands of Venezuelan migrants as well, but the legal battle is not actually done. By no means is this definitive, saying the status will be revoked permanently, but they are allowing the president to do that at this time while we see it playing out further in lower courts.
All right, Kayleigh Lyons, really appreciate the reporting, and great to see you in New York. That is Balance of Power co-host Kayleigh Lyons. Let's get back to one of the big corporate stories of today, and that is shares of Gap plunging this morning after the retailer predicted its tariff impact could be as much as $300 million. Let's get right now to the CEO of Gap. His name is Richard Dickson. And Richard, it's great to have you with us. Normally I would ask about the results themselves, but I have to start with the share price, down 19.8% at the moment. Matt and I were talking about earlier how CEOs often come on this program and tell us that they don't watch the day-to-day movements, but I feel like this move is hard to miss, Richard. So what do you do with this? What does the rest of your day look like? Are you having all hands meetings? Are you in conversations with your board? What does it look like?
Well, I think it's true. I mean, we don't manage our day-to-day business focused on our daily stock movement. Clearly, it's a dynamic market out there. But much more importantly is that our brand reinvigoration is working. And it showed up in our results. We delivered another great quarter, a consistently great quarter. We exceeded expectations across all key financial metrics. Our strategic priorities are clear. And despite a dynamic environment, we're staying firmly on course. And it's showing up in the results. Comps were up 2%. That's the 5th consecutive quarter of positive comps. It's also the 9th consecutive quarter that we gained market share, which indicates our product is resonating. We expanded both gross margin and operating margin during the quarter. We controlled expenses. We increased our EPS by 24%. We strengthened our balance sheet. We have a strong cash flow balance, and we've got $2.2 billion. The Q is really another proof point that the strategy is working. I remain incredibly optimistic, yet realistic, about the opportunities ahead, and we're all navigating a highly dynamic environment.
I have to say, though, that, your company has lost fully 1/5 of its value today. So you were worth over $10 billion in market cap, and now it's $8 billion. That's the kind of thing that you just can't look away from. And it looks like that's all down to the tariff impact headline, which you said as much as $300 million. That's less than 1% of your operating income. I mean, you have $15 billion in sales, so it's a seemingly small number. Don't you need, Richard, to analyze why the market is attributing so much to this relatively small number?
Look, of course, we're on top of and studying, obviously, the marketplace and the reaction, but we are running a business for the long term. And like any business, we're constantly navigating complexities. In this case, it's tariffs. But it's our responsibility to do so without compromising the long-term integrity of our strategy. And most important to the extent of that strategy is our consumer value proposition, which is resonating. Now, in relation to the tariff conversation, we did share that we've already mitigated over half of the anticipated impact tariff. We've done it through very thoughtful adjustments to sourcing and manufacturing and our assortments. We also shared that we remain committed to achieving the remaining net impact of about $100 to $150 million, primarily also weighted to the back half. Now, we've been diversifying our sourcing footprint for several years. China, as an example, used to be a top sourcing country for us, and now we also shared that we expect it to be less than 3% by year end. So at the end of 2026, we're also planning for no country to account for more than 25%.
Right.
So our goal, first and foremost with our investors, is transparency. And we were very purposeful in separating the outlook from the estimated tariff impact. And we believe that the outlook is providing a perspective on the underlying health of our business, which is working as evidenced by our performance. As well, we shared the estimate of the impact of the tariffs, which could still change. As of a couple days ago, it was also changing. July 9th is also another milestone moment with yet another update on tariffs. So the estimated tariff provided that we shared was primarily weighted to the back half, and we'll continue to update as we move along. But we're very focused on executing our playbook. It is showing up. Our two biggest brands, Gap and Old Navy, are winning in the marketplace.
Right.
We're building stronger identities. We're driving new customers to our site. And we're very excited about, obviously, the back half of 2025.
Well, Richard, it's a fair point that the tariff landscape, it changes day to day, hour to hour in some cases. So we'll keep a close eye on that. Let's talk a little bit more about your portfolio. You mentioned Old Navy. You mentioned Gap doing very well and performing strongly in this market. But talk to us a little bit more about Athleta, about Banana Republic, which haven't seen that same momentum. How do you specifically plan to revitalize those brands?
Well, as you mentioned, first let's start with Old Navy, because Old Navy is our largest brand in the portfolio, and it continues to deliver. This is the 9th consecutive quarter of market share gains. Comps were up 3%. We're winning in the categories that we've intended to drive, active and denim. We've been pursuing a leadership position, and the market share continues to gain quarter after quarter. We also just introduced Old Navy New Moves, a new campaign that really solidifies and supports our activewear strategy. It is a clear example of how we're accelerating Old Navy's adoption of our playbook. We take big ideas and big product categories, we amplify them with great storytelling, and then we connect them to the consumer. Denim was another standout category. Share gains across that category. We're the 4th largest adult denim brand in the U.S., and these are real elements that we can count on that are giving us the confidence that ultimately we're going to deliver in 2025. Gap is another brand that's gaining momentum. We're incredibly proud of the progress that we're making with Gap. Comps up 5%, 8 consecutive quarters of market share gains. Incredible performance based on innovation, product newness, compelling marketing, collaborations that are driving a whole new generation to Gap. Recent campaign with Parker Posey, which resonated with consumers. A great example, again, of our playbook, and the strength of that brand is going to continue, and we believe Gap is well positioned to continue the momentum. Right. Banana Republic is a brand that we've been reestablishing. Fundamentals are improving. We were flat for the quarter. We're seeing trends continue in men's, which we're very proud of, and the team has done a great job strategically deploying more marketing to culturally relevant storytelling. Our women's business is starting to take traction. The collaboration with White Lotus was incredible, and we believe that that brand, quarter after quarter, is starting to see great progress. And lastly, just to finish up our portfolio, Athleta is an incredible, valuable place in our portfolio, and in the industry, by the way. We've been resetting that brand to more effectively compete in the marketplace. We did share that we expected to be a bit choppy as we continue to fix the fundamentals. We provided that outlook yesterday in our call. But Athleta needs to become a much more exciting brand for our consumer. We had an over-rotation that we discussed last quarter towards new consumers, which we did attract, but we still didn't have enough compelling product to appeal to our large consumer base, and it showed in the performance. So we're investing in design talent, we're driving newness into the brand, and we have more work to do, but we're committed to really taking the necessary steps to reset that brand.
Richard, you seem to have a particular affection for Banana Republic. You're personally running that brand. Are you any closer, though, to finding someone else to do some of that work for you?
We've met some extraordinary talent. We are very close to what we believe will be the right pick at the right time. And as you see, we're continuing to strengthen the brand. So as much as obviously we're sort of looking for the right person, we take these positions very seriously, and we want to make sure that we have the right talent that can take that brand and drive it to the next level.
All right, Richard, thanks so much for your time. Really appreciate it. Gap CEO Richard Dickson talking to us about his results. Let's get a quick check on what's going on in the markets right now. We're looking at a little change on the S&P 500, 5907, the level there after a bigger drop earlier in the session, although, it wasn't huge. But it does look like, Katie, we're getting back a little bit as we finish out the week, finish out the month to maybe closer to turning to a higher?
We'll see. We're 6% higher on the month. I would say that the time to, stay tuned right now, but the time to tune in is also 3:30 p.m. because that half-hour window to the close on month end will be interesting.
So you're actively promoting Romaine Bostick's show, The Close, that's what we do. We care about.
It should be electric.
All of the brands here.
The open promoting the close, it makes sense. But it is interesting, that conversation we had with Richard Dickson, and we did press him a bit on the share reaction today.
Well, you have to when the shares fall 20%.
To be fair, the expectations were sky high for Gap because take a look at the year-to-date chart. Through yesterday's close, this stock was 19% higher on a total return basis for 2025. You compare that to the rest of the consumer discretionary sector, obviously well outperforming. So you can really see what a big bite today is taking out of that year-to-date performance. Now negative on the year, so we'll continue to see how that trade develops. But let's take a look at some of the other single stocks moving this hour. We're going to do that with Bloomberg cross-asset reporter Denitsa Seikova. And do you have any positive news for us?
Yeah, let's start with Costco. We've been talking about only bad consumer news, but I'm going to bring some good ones. Costco posted better than expected earnings. Of course, everyone has been worried about tariffs and economic uncertainty. And so far, what we're seeing from this earnings report is that Costco defies all those warnings. The retailer said it generated earnings per share of $4.28, which is well above what the street expected. We saw a lot of warnings from Target, from Procter & Gamble. Obviously, Walmart had solid results, but everyone is watching that space. It's been under a lot of scrutiny, but Costco remains very strong, more than 10% gain year to date, showing strong consumer. That said, they said that they will raise prices later this year, but it will be based on item by item. They're putting some prices down. Obviously, egg prices are going down, but raising some prices according to the tariffs.
Is Costco is that the one with the hot dogs, the cost of $1?
Of course,
that is
$1.50. Yeah,
I've never had one, but
I haven't.
You've never been to Costco, or you've never had one of the hot dogs?
Never had a Costco hot dog. It's not.
I haven't as well, but it's legendary.
I'm sure Matt has.
Yeah, no, I've definitely participated in that offering. It's interesting. American Eagle, we just talked to Richard Dickson from Gap, right? Their shares are down 20%.
Yeah.
Abercrombie and Fitch, to be fair to Gap, right? They're getting crushed. They're off 40% year to date.
Yeah.
American Eagle is, the year to date picture is bad also, down 30%. But those shares have turned higher on the day, even though they had weaker sales and more discounting.
It's an incredible reversal story. It was, when I was writing this, it was down about 8%. Now we're in positive territory. As you said, this is a different picture from Gap because the stock is actually down 32% year from date. So perhaps investors saw maybe a dip buying opportunity. That said, the report we saw today indeed brought more negative news. The firm forecasted operating income for the second quarter missed what analysts were expecting. They said the fiscal 2025 guidance remains withdrawn amid uncertainty. There are all those fears about consumers. We saw weak sales from both of their brands, and we saw a lot of discounts. So if you look at what we've heard from analysts and price target, there isn't too much optimism about the stock. But of course, we saw a big reversal today. So perhaps there is some optimism or some dip buying from the super low levels.
Yeah, still a brutal year-to-date chart there for American Eagle. Let's talk a little bit about a different industry and talk about Marvell Technology, also coming out with earnings. Seems like traders aren't too happy with it.
Yeah, this wasn't a bad report. It was actually in line with expectation. But this, of course, we're going back to AI, we're going back to chip makers, and all those companies having very high valuations. And this was exactly what we saw. Slightly disappointing report, but the reaction was pretty bad. It was down as much as 8%. Now some of those losses are fading, but still a pretty rough day for a report that wasn't that bad. What analysts are seeing is that they're seeing lack of upside in data centers in the first and the second quarter. And generally people are saying that they are not seeing a massive payoff for that AI investment and AI hype. The stock is down a lot this year. If you zoom out, it's down more than 40%. Ooh. It's also a day when Nvidia is down, so I feel though that weighs definitely on the whole field. But it's been a rough year and another rough day today.
Yeah, even over the last 5 years, they haven't doubled. So they're only up 90%, which
pedestrian.
In the AI chip space.
In the AI chip space.
It's basically unchanged.
Exactly.
Yeah.
Danita, thanks so much for joining us. Danita Tsakova from the Cross Asset team actually sits right near Katie on the other side of the building. Coming up, the president wants to bring manufacturing back to the U.S., but do we have the labor force to fill those positions? Well, we have an expert to talk about this. Janice Bryant Howroyd, ActOne Group founder and CEO next. This is Open Interest. Fresh labor data showing a strain on the job force, with jobless claims hitting a multi-year high. Let's get a read on the labor market itself with Janice Bryant Howroyd. She is the founder and CEO of the ActOne Group. ActOne is a workforce solutions and technology company that supports clients across more than 43 countries. JBH, great to have you here in the studio. Thanks so much for visiting us at 731 Lex. What's your take, first off, on the state of the labor force right now? We're all watching very closely to see if companies start to lay off more, companies start to fire, and it doesn't seem to have happened quite yet.
No, it hasn't happened quite yet. And at risk of seeming overly optimistic, Matt, I have to tell you that I think we're in a great moment for opportunity. Now, most people think immediately, okay, so you're just going back to that meaning of opportunity is another way of saying challenge. Yes, I am. However, there's a really positive upside to it. And you're asking about the labor market and people not really being laid off so much right now in the commercial sector. That's what we're finding as well. However, how the labor market continues and how individuals retain their jobs is going to depend a lot on their readiness for the new way we do work.
Well, let's talk about that a little bit more, because you talk about potentially the new way we will do work. My mind goes straight to AI. There's all these prediction out there about how AI is going to change our daily life, but also how we actually work and earn a living. And I'm wondering what impacts you're starting to see when it comes to AI and the workforce.
You're generous to bring that up, Katie, because AI's been around for a long time. I mean, since the 50s, and it's already impacted how we live. I think because there's such a phenomenal jump now with the chat GPT-ness of things, people are becoming more aware of it in their daily lives because they're using it more in their daily lives. But your automobiles have been there for you for quite some time, over a decade, integrating this type of technology. Understand there's a difference between AI and AI agentic. And what you're leaning in on, Matt, when you ask about the labor market, agentic workforce is where we're seeing opportunity. And that's why companies don't need to lay people off, because they can team up in new areas or in highly transactional areas with an agentic worker that then supports their human worker.
Yeah.
Human in the loop is really key to how we do anything, whether we're doing that in the U.S. or whether we are doing it across the 43 countries you mentioned ActOne, sir.
I think it's fascinating that you're thinking on the AI level and how people do, I think, really high paid work. When I think of the labor force, I think of the factory floor. And clearly that has diminished in the U.S. over the past 5 decades. But President Trump is looking to bring that kind of manufacturing job back. You know, there was a time when when one salary from a manufacturing job could support the whole family. Is that ever coming back? Janice, do you ever see manufacturing jobs coming back to this country in force?
It's not coming back. We're not going to do things the way we did, nor do we want to. Recently, I visited my hometown of Tarboro, North Carolina. And when I grew up, factories were the good jobs in town, right? And my dad was a factory worker. The way he did work will not come back, but the work he did will come back. And those factory workers you're talking about being a one-income earner for a family, that still can exist in manufacturing. It's going to exist in a different way. Robots are not going to replace people. They're going to enhance what people do. And so workers are going to need to upskill or reskill to the environments they get placed in. Here's the good thing if you're concerned about the cost of skill. Universities will not go out of fashion, and I know there's a lot of conversation right now about universities in this country as well. Community colleges are supporting people to become the new millionaires. When you think of plumbers, you think of people who do utility type work. But in the manufacturing space, wages aren't going to go down. The work that the manufacturing worker does will go up and will be highly enhanced in a human-in-the-loop environment.
Right. Well, Janice, you hit on a very cynical concern of mine, which is that we're going to try to...
Oh, you don't look like a cynic at all.
Well, you know, let's take a peek inside.
Looks can be deceiving.
That is certainly true. But
you're looking great, Katie. What's the question?
A cynical concern I have is that, you know, we're going to work to revitalize the manufacturing industry. We're going to bring back or create all of these jobs, and then just in the next decade or so, we're going to replace everyone with robots. It sounds like what you're saying is you don't necessarily see it unfolding that way.
You know, there is some work that will be robotically replaced, okay? Now, when I'm in Los Angeles, I see all the cars rolling around without a driver, okay? That is not going to be the ultimate for the workforce. We will learn to work differently. Years ago, I told a story of how when I visited my husband's hometown, he shared with me that that was the road that I shared. He said, look, this is the road that I was on the back of a horse and buggy when my family delivered ice.
Wow.
And he said, you know, the Iceman was one of the most revered people in the community. They delivered, they gave kids chips off the ice. And then one day he showed up to one of his customers and they didn't need him anymore. He thought he was in the ice business, but really he was in the business of refrigeration. And I don't know that you know the brand Frigidaire, but when it came out, it replaced ICE workers. So it's understanding what industry you're in, what jobs that what is the outcome of your work, and then upscaling and reskilling to be able to fulfill that. And companies are doing that.
Right.
Gap is a client of ours, and you just talked with Richard. They're a splendid client. They're looking at how they are reviving and revisiting what made them so great and what will keep them so great. And a lot of that is going to for instance, in our company, let me give you a for instance that can help them. We have recently acquired a business called Assembly Industries. Assembly is an agentic workforce. It goes in and it helps you to identify where you have highly transactional work that needs to occur. This does not replace a worker. This enables a worker to do the things they're skilled at well.
It is.
It continues to keep a human in the loop, but it can work as an independent team member. That's where we're headed. I'm not looking to replace people. I'm looking to enhance how people work, ergo how we all live.
It's a really fascinating point and incredible take. Thank you so much for joining us. Janice Bryant Howroyd there of the ActOne Group. Coming up, Apollo is partnering with JPMorgan and other major banks to trade private credit. We'll bring you the details on that next. This is Bloomberg.
Well, State Street is doubling down on its bid to bring private assets to a broader spectrum of investors, even as its initial ETF experiment in this area has struggled to gain momentum. Let's break it down now with Bloomberg Intelligence ETF analyst Eric Balchunas. So build it and they will come. That didn't necessarily happen the first time around. Why would State Street's second attempt at a private credit ETF go over better?
This is interesting. It's possible that's what they're hearing from their clients. You know, when you have an ETF, you tell your salespeople to go talk to advisors. Maybe the advisors are like, look, I buy something in the short duration area of this, but I'm not going to buy this sort of middle duration. You know, also the active element is way more valuable in short and ultra short. Like, you know, we just discuss this all the time on ETF IQ. Ultra short, like the bonds in that category, active makes over half. So maybe they're just finding a little more demand from clients. But I'm with you. It's a little bit of a head scratcher. Priv got a lot of hype, but it was a bit of a flop. I mean, it had 50 million of an anchor tenant in there, but no flow since. Volume is light. I think that just generally private credit just isn't interesting, doesn't really pack a lot of punch. There's not a ton of private credit in the ETF. I think private equity might have a better shot at capturing the imagination of investors, but we'll see.
Right. Matt, just for context, so PRIV, their initial private credit ETF, launched in late February. It's only seen 2 days of net inflows in its entire existence.
I find that nuts, because I don't agree with Eric that it's not interesting.
It is interesting.
I think private credit is interesting, and I feel like more people want to get more retail investors would like to get a hold of that.
That emotion hasn't translated into flows. And Eric, I want to talk about wrappers here. Of course, you and I are ETF people, so this might be sacrilegious, but it seems like interval funds, more and more issuers are gravitating towards interval funds for retail access to private assets versus ETFs.
Yeah, Vanguard has something coming out, Blackstone. We'll see. I'm skeptical on interval funds. To me, they are essentially a mutual fund, and so it's like going backwards. It's like you have this cool new investment strategy, but you're putting it in like a compact disc or a cassette tape. Nobody really wants to consume anything that way anymore. So I don't think interval funds are going to work. Also, let me tell you this. ARK has an interval fund that's 100% privates, the ARK Venture Fund. And it was launched at peak ARK Mania, has about 150 million. Meanwhile, XOVR, this random fund added SpaceX, only 10% SpaceX, and the rest is public stocks. 350 million came in like 2 months. So to me, I think people really want private equity in the ETF. That would be the hot area. I think private credit, I know it's interesting for institutions. I just don't think it's that interesting for advisors or retail. And I think the wrapper of the ETF is where they want to have it. I don't really think you're going to find many bites in the interval fund. I could be wrong. Some people disagree with me on this. I just think it's a hard sell to go into something with 5 letters in the ticker.
Yeah, we'll see. Maybe people like.
Can I just ask, we only have a minute left, but who is your favorite rapper, Eric?
Oh my gosh.
Can I say the Beastie Boys? I'm Gen X.
Yes, you can say that.
I like the old. I like Kool Moe Dee. I like that late '80s rap where they use thematic imagery. And whatnot.
I'm like a Public Enemy guy. Katie, what about you?
I don't know if I have a favorite rapper. So my favorite rapper is the ETF rapper. I'm going to leave it at that. Eric Balchunas of Bloomberg Intelligence. Have a great weekend. Tune in to me and Eric and Scarlet Fu on ETF IQ on Mondays at 12 p.m. New York time.
That's the name of your show.
Yes. Please also subscribe to the ETF IQ newsletter, Bloomberg.com/ETF IQ newsletter. It's how I feed my cat. So please subscribe and then open it.
So the show and the newsletter are both ETF IQ.
We're consolidating the brands.
I love it.
Yeah.
Coming up on Monday, Stuart Kaiser joins us from Citi, Raquel Oden from HSBC, and Henrietta Trey's from Veda Partners. Have a fantastic weekend.